Good morning, everyone, and thank you for joining us today. I'm excited to kick off our presentation on Techno Electric and Engineering Limited Investment Advisory. Today's focus is on unlocking value as we take a deep dive into their impressive journey and explore the future potential beyond Q for FY25. Over the next few minutes, we'll look at their recent performance, strategic initiatives, and growth prospects. So, let's get started and discover what makes Techno Electric a company to watch. Let's take a closer look at Techno Electric's exceptional financial performance. First, we're seeing a remarkable 91% growth in profit after tax in the fourth quarter. This indicates a strong and consistent upward trajectory in profitability, reflecting the company's ability to generate more profit compared to the same period last year. Moving to the full fiscal year, the profit after tax has surged by 60%, which underscores the overall positive momentum and solid financial health of the company throughout the year. Another key point is the EBITDA margin, which stands at 13.66%. This is an important indicator of operational efficiency, showing that Techno Electric is managing its core operations effectively while maintaining healthy margins. Lastly, the company generated an operating cash flow of 837 crore rupees in FY25. This is a significant turnaround and demonstrates robust cash reserves, highlighting the company's liquidity and strong capital position. Overall, these figures reinforce the theme of financial strength and resilience, positioning Techno Electric as a leader with a solid foundation for future growth. Now, let's take a closer look at our operational and execution excellence. One of the key strengths we have is our ability to deliver complex projects efficiently. For example, we've achieved record time completion for large-scale infrastructure like the 765 by 400 kV substations, which is a testament to our team's expertise and streamlined processes. Moving on, managing working capital effectively is crucial, especially as our revenue scales up. Despite the growth, we've maintained tight control over our working capital, ensuring smooth operations without unnecessary financial strain. Another important point is that we are a debt-free EPC company. This financial stability allows us to focus on growth and innovation without the burden of debt, giving us a competitive edge. All of these factors, delivering complex projects quickly, controlling working capital, and maintaining a debt-free position, contribute significantly to our strong growth momentum in our core business. They demonstrate our commitment to operational excellence, which is a fundamental part of our overall strategy and success. Now, let's take a closer look at our order book and the growth we're expecting in the near future. Currently, our order book stands at an impressive Rupee 11,000 crore, which provides a solid foundation for our revenue visibility. In fact, this order book gives us about 4.6 times the revenue visibility for FY25, meaning we have strong confidence in our future earnings. Looking ahead, we've set a revenue guidance of 3,600 crore for FY26, indicating our optimistic outlook for continued growth. What's really encouraging is that we're projecting a strong top-line expansion, driven by this robust order pipeline. Additionally, our expected earnings per share CAGR, or compound annual growth rate, is in the range of 25 to 30%. This highlights our commitment to sustained earnings growth, which aligns perfectly with our overall theme of long-term value creation. So, in essence, this slide underscores our healthy order book, the promising revenue outlook, and our focus on consistent earnings growth, key indicators of our company's resilience and growth potential moving forward. Let's now turn our attention to our strategic diversification plans and future bets. One of our key initiatives is developing AI-ready data centers. We're aiming to target around 50 megawatts of capacity by FY27, and these data centers are designed to generate high EBITDA margins, which will significantly boost our profitability. Next, we're focusing on smart meter projects. We've secured a 2.5 million meter concession, which will provide us with a steady, long-term annuity revenue stream. This aligns well with our goal of creating reliable, recurring income sources, and expanding our footprint in the smart infrastructure space. Finally, our capex strategy involves a planned investment of around 10,000 crore rupees over the next 5 to 7 years. The best part is, we intend to fund this predominantly through our internal accruals, which demonstrates our confidence in generating healthy cash flows and maintaining a strong balance sheet. All of these initiatives, AI-ready data centers, smart meter projects, and our targeted capex, are interconnected components of our broader growth strategy. They're designed to position us well for the future, diversify our revenue streams, and strengthen our market leadership. Now, let's turn our focus to how we prioritize our shareholders. We're committed to delivering value, and one way we do that is through our dividend policy. Currently, we're offering a dividend of 9 rupees per share, which reflects our dedication to providing steady returns to our investors. This demonstrates our confidence in the company's ongoing performance and our commitment to rewarding our shareholders. In addition to dividends, we also maintain substantial cash reserves, around 220 to 225 rupees per share. This level of liquidity is crucial because it gives us a strong safety net, ensuring we can navigate uncertainties and preserve capital when needed. Overall, these points highlight our balanced approach. We're focused on rewarding shareholders while maintaining a solid financial cushion. This strategy aligns with our broader goal of sustainable growth and stability, reinforcing the trust you've placed in us. Now, while Techno Electric certainly shows a lot of promise, it's important to keep an eye on some potential risks that could impact future performance. First up is execution risk, especially with their new data center segment. These projects often involve long payback cycles, so it's crucial to consider how smoothly the company can execute and realize the expected benefits. Next, there's policy dependence. For example, their smart meter initiatives and infrastructure contracts are highly sensitive to government policies and regulatory changes. Any shifts here could influence their growth trajectory. Then we have valuation risk. The current stock prices seem to already price in a lot of optimistic growth for FY26 and 27, so there's a chance that expectations are somewhat baked in, which could limit upside if growth doesn't meet those high hopes. Lastly, we should be mindful of capex pressures. Delays in asset monetization could put strain on their capital expenditures, potentially impacting their ability to fund future projects or distribute returns as planned. In essence, while the outlook is positive, being aware of these risks helps us make more informed decisions and understand the bigger picture behind the growth story. Now let's look at our valuation view, which is important to keep in mind, but I want to clarify that this isn't a specific price target. Instead, we're focusing on the potential valuation based on current estimates. For the fiscal year 2027, we are estimating earnings per share to be around 75 rupees. Given that, we typically look at a price-to-earnings ratio, or PE multiple, in the range of 18 to 20 times. Multiplying the EPS by these PE ranges gives us a target valuation range of roughly 1,350 to 1,500 rupees. Now, an important point here is that if the current market price, or CMP, drops below about 900 to 1,000 rupees, it could present an attractive opportunity. In such a case, we might see upside potential of 30 to 60%, which is quite significant. And what's more, this kind of margin of safety is critical for making prudent investment decisions. So overall, this slide emphasizes that while these are not strict targets, they give us a framework for understanding the stock's potential valuation and the risk-reward profile based on current estimates. As we come to the final slide, I want to leave you with a few closing thoughts. First, we see strong growth visibility in our core EPC business, which means we have a clear path forward and confidence in our ongoing projects. This stability is crucial as it underpins our future expansion. Next, we're making scalable, high-margin bets, investments in areas like data centers and smart meters. These are not only high-growth sectors, but also offer the potential for healthy margins, helping us increase profitability while diversifying our portfolio. We're also committed to maintaining robust financial discipline, especially when it comes to capital allocation. This disciplined approach ensures we invest wisely, optimize returns, and keep our company resilient. Most importantly, Techno Electric is evolving into a debt-free infratech hybrid. This transformation makes us more agile and better positioned for long-term success. For investors, this means a stable, forward-looking company with a solid foundation and growth prospects. In summary, we're confident that these strategic directions will help us sustain growth and create value for the long term. Thank you for your attention and trust.